My name is James Bridgeforth. I'm a young and very successful investor. And when I first started investing, I lost thousands of dollars. Not because the market was bad, but because I simply didn't know what I was doing. In this video, I'll share the 7 lessons that could have saved me time, money, and stress, so you don't have to repeat my same mistakes. Whether you're just starting or already investing, I'll walk you through the exact mindset, tools, and strategy I wish I had from day one. The first strategy I want to touch on is timing the market versus time in the market. When you're going into investing and you're trying to time the market, it can be very difficult. There's many people who solely and try to only invest when the market is down or when they can time the bottom of the market. But I'm here to tell you that that's quite impossible. That's the main reason that people utilize the strategy of dollar cost averaging. So you're constantly buying at certain points so it averages your cost per share out, because it's very difficult to time the bottom of the market. You can buy at certain support levels, but actually timing the bottom is near to impossible, which is why timing the market can be very beneficial for beginner investors and people that are already investing. For example, during 2020, when we had the great COVID recession, the market was down 20-30%, and you probably own companies and you were buying shares during that time, and the market just continued to go down. But if you find the correct investments, the correct assets and tools such as crypto, stocks, whatever you want to invest in, and you buy during times of fear, your time in the market when you're long-term investing will outplay you actually timing the market. Because if you're timing the market, there could be opportunities that you're missing because you're anticipating that it's going to go lower, but it's actually not. So let's say you invested during 2020 during COVID. You bought a stock. Let's say you bought Apple stock, a couple shares of Apple stock, and that price of the Apple share kept going down 20-30% after you've already bought it. It's impossible to time the bottom, and you're looking, because you're looking at a short-term mindset, that I'm down 20-30%. So you're trying to time the market, and that's not good. But the time in the market during that standpoint would be very beneficial if you look at a longer time frame. So you're looking in that moment that you're down 20-30%. But if you zoom out 5 years from now, as we're sitting in 2025, you will realize that the buys that you made during COVID are actually up 100 or 150%. And I'm speaking on this from personal experience. If I sat during COVID or even during any recession and waited solely on the greatest opportunity to buy, I'd still be waiting. There's going to become opportunities where you have to understand that, let me just get my shares in. And if I truly believe in the companies and assets that I'm buying, then I'll buy at certain times of uncertainty, knowing that in 5 to 10 years, the share price will be much higher than it is today. That's why timing the market is much more beneficial than trying to time the market, which is nearly impossible. So the second lesson I want to touch on is compound interest, which actually piggybacks off what I just spoke on in the first lesson. So compound interest can be very beneficial because let's say you have an initial investment of $1,000 and you get a 20% return that year. That following year, if you get another 20% return, you're not getting a 20% return on your initial investment of $1,000, but you're getting a 20% return on your investment of $1,200. This is one of the many ways that young and beginner investors, or even older investors, can quickly grow their wealth over long periods of time by using this exact strategy. So when you go on investing calculators and you're going on your phone or your laptop, whatever device you're using, and you're going on these investment calculators typing in, if I invest $100 a week, $100 a month, or $100 a day, and I get this certain return annually, what will my money look like when I retire? Maybe at 55 or 60. And you see that you're gonna retire with maybe 1.5, 2 million, 3 million, however much you invest. And you're looking at this number like, how did I get this grand number from such a small, simple investment? That's because of compound interest. So the way it works is, like I stated earlier, you're not gaining interest or you're not gaining percentages on your initial investment, but it's constantly compounding over time, which is one of the best ways to grow your wealth and one of the most beneficial ways for you to separate yourself in ways that you would have never imagined before. So that second lesson of compound interest is one of the most important and key ways to growing your wealth. The third lesson that I wish I knew is that risk isn't a bad word. You have to understand that when you're going into investing, many people are telling you how risky it is or how risky certain investments are. There's many people that tell you should only invest in index funds. But I'm here to tell you that risk isn't a bad word. You have to understand that risk is very subjective. Risk only matters if you don't understand what you're investing in. So let me break that down. So let's say that you're investing in a stock and you don't really understand the market. You don't understand technicals. You don't understand the news data that's driving this said stock. So you're just investing in it blindly. Now, that's a risky investment. But if you do the knowledge, if you look at the news data and understand how it affects the market, and you look at the technicals and understand it's at a support level, this stock could possibly go up, or it's at a resistance level, this stock could possibly go down, which will give you a direction of where this stock or company is going to move in the future, then yes, it is a risky investment because you're going into it with no knowledge, not understanding the way that the market moves and the certain risk and rewards that come with it. So risk is very subjective. When I first got into the market, I was just buying stocks. I didn't really understand what I was doing. I was just buying stocks from companies that I heard of and that I liked. But that can be viewed as risky to some people because I didn't understand what I was doing. But now that I fully understand what comes with the market, how to identify stocks, how to identify good crypto, how to identify swing trades and good times to get in and get out the market, then I understand that the assets that they're telling me not to invest in actually aren't that risky. There's many people that tell you don't invest in meme coins, don't invest in altcoins. And I agree to a certain extent. If you understand and do the knowledge, then I think that you could quickly utilize those to grow your wealth at a much faster pace than you wouldn't have before. But if you don't have the knowledge, then I highly suggest that you don't invest in certain assets until you fully understand and do the knowledge that you need to take the risk away from investing. So risk isn't a bad word, it's only subjective, and you just need to do the knowledge. The fourth lesson that I wish I knew is to not follow the hype. There's many times in my early investing journey where I was investing in companies just because I saw how they previously performed, and I saw the returns that people were getting by investing in these companies or even crypto. But you have to understand that most of the time when these companies have already ran up to drastic percentages, that you've probably already missed the train. There's a saying in Wall Street where they say that when people are following the hype or they have this fear of missing out and they buy it in opportune times, that they're actually dumb money. That's the way that large hedge funds actually look at retail investors who make poor decisions. So when you see a company run up or you see a certain crypto run up, you have to remember, okay, this is a pretty good company that caught my attention. Let me not buy at the top, but let me identify a near support level that I could then get my good entry in so that I can also partake in the percentages that could come in the future. So that's the same way that I did it. I watched Nvidia run up from $100 to $600 or $700 per share. And then I waited for Nvidia to come down to a near support level of $500. And then I was able to buy the share at that price and be the beneficiary of it running up from $500 to $1,000. This is the same way that many companies work. I'm not saying that this works for all companies. I'm specifically talking about good companies that you could benefit from if you understand. Don't get FOMO. It's going to be hard. There's times where you see, oh, there's so many percentage returns that you could get on your money, but you have to understand, be patient, control your emotions, and understand that this isn't something that you should be chasing. The fifth lesson I want to touch on is actually going to piggyback off the one we just discussed earlier, and it's to understand that your emotions are your real enemy. You have to understand that when you're investing, it's going to be times where you're going to invest in a company, crypto, or stock, whatever it is, and that stock or crypto is going to go down 20, 30, 40%. But you have to understand, should I sell during this time, or am I just trying to get tricked out the market? So there's times during a recession where my whole portfolio is probably down on the day. I've been down as much as $1,500 to $2,000, even more in just one day. And I'm saying this from a perspective of that I've been in this situation before. It's something that all investors actually struggle with. Nobody actually wants to look at their account and see the money that they worked hard for go down in an investment that they thought was going to perform well. But if you're in good companies, you understand that this is another buying opportunity for me to take advantage of. So instead of looking at it like, okay, the stock that I invested in is down 20, 30%, maybe you should add more shares to your position, average your total cost per share, and understand that in 5 to 10 years that you could really get a large gain because you understand that this is a good company that'll perform well and makes profit year over year, and that I'll be the beneficiary and soon be able to gain large percentage returns over years to come and be able to grow my wealth further than I was before. But the first thing is to understand that it's all emotional. So when you lose money, don't get scared. Understand that you're in good companies. Understand that the work you did prior to investing in these companies is what led you to invest in them in the first place. Understand that all the good things that were good about this company while it was running up are the same things that are good about the company while it's going down. Most of the time, it's just news-driven data. So like right now, we have a lot of tariff wars. We have a lot of wars going on in other countries that could cause a downturn in the market. But there's nothing wrong with the companies themselves. It's all news-driven. So if you understand that there's nothing wrong with the companies themselves, the same company it was when it was $1,000 per share is the same company it was when it's $800 per share, then you understand that there's nothing wrong with the company. I should keep my investment, don't sell, and just weather the storm. This is a very important strategy that I wish I knew when I first started investing, and to understand that emotions are not something that should be able to control your investment decisions. The sixth lesson I wish I knew was to actually have an exit strategy. When investing, there's going to be many times where you're going to gain large percentages on your return, but you have to understand that the stocks or crypto or investments that you're investing in are not going to run up forever, especially in crypto, where it's a much more volatile investment class. So when I was investing in crypto, I was investing in altcoins and meme coins, and I had to set a target in my mind of when I was going to sell, no matter what. I didn't care how much momentum, how much volatility it had going in the upward direction. When it got to this certain price point, I was going to lock in profit and sell. You always have to have an exit plan. So you don't make money on the exit. You really make money on the buy. So when I'm buying at good points and I'm buying at smart positions or that I feel would be beneficial, I'm buying at this certain point, already knowing in my head, let's say I'm going to buy at $20 per share, but I already know in my head, I'm going to sell at $30 per share no matter what. This is what helps you become a profitable trader and helps you take your emotions out of it. See, there's many times where young and beginner investors, even myself, invested in certain assets. They bought it and they see that, okay, I'm up 100%. I'll sell when I get to 150%. It gets to 150% and then you're telling yourself you're going to sell when it gets to 200%. And then before you know it, the stock tanks. You have to understand that you have to put in an investing strategy and an exit plan. This is something that was very beneficial for me, and I know many successful investors that use this same strategy, and I think it's one that you should implement in your own investing strategy. The last lesson that I wish I knew when I first started investing is that you don't need to be an expert to start. There's many times where you first start investing and you want to watch all the videos, read all the books, do all the knowledge that you possibly can before you start investing, and I'm not saying that's wrong, but the most lessons and the most knowledge that you're going to gain from investing is actually getting your foot in the game. When you get your first share, you understand so much more than you would have from just reading a book or watching other people do it. When you get your first share of a company, you learn how the platform that you're investing in works. You understand what it means to buy shares, how average cost works, how percentage gains works, how to sell or buy these shares, how to set a stop loss. There's so many things that you learn from just getting your foot in the game. You don't need to be an expert. You just have to be eager to learn and willing to take that first step forward to truly gain the knowledge that will soon set yourself apart from everybody else. Investing isn't something that you will learn overnight. I learn new strategies about investing every single day. I learn new lessons. I learn new ways to think. I learn new ways to analyze the market. There's many things in investing that you will always continuously learn. But if I sat back and tried to understand or learn everything at all at one time before I solely started to invest, then I wouldn't be in the position that I'm in now. I would still be learning. There's so much to learn that there's no way that you're actually going to be able to grasp all this information and be able to invest. The true knowledge that you're going to gain is from experience. There's going to be times where you lose money. That's another way that you gained experience. There was times where I've been up a lot in a position and I've watched it come all the way back down. That's an experience gain, because I talked about my last strategy, how you have to have an exit plan. I wouldn't have learned about an exit plan if I didn't get started. So that's a key point that you have to understand, that you have to just get started when investing. Don't try and gain as much knowledge as possible before you do, and then it pushes back the timetable of when you start. You're never going to be perfect. You're always going to continuously learn. But trust me, if you gain experience by just getting your foot in the game, you'll truly be able to benefit great returns, and you'll set yourself apart further than you would have ever imagined. And your journey of investing will take you to places that you could have never saw before. Thank you all for watching this video. That's going to wrap up the 7 lessons that I wish I knew when I first started investing. Feel free to like, comment, subscribe, turn on that post notification bell so you never miss an update, and I'll see you guys in the next video.